The University of Queensland acknowledges the traditional owners and their custodianship of the lands on which we meet. We pay our respects to their ancestors and the descendants, who continue cultural and spiritual connections to country. We recognize their valuable contributions to Australian and global society. Hi everyone, I'm Nandu, and I did a Bachelor of Business Management with a major in Business Information Systems and Marketing, graduating 2022. And I am part of the Young Professionals portfolio in the UQ Young Alumni Board. And tonight, our first speaker is someone who's passionate about helping people take control of their finances. Monique Dooney is the founder of The Wealth Doctor, a boutique financial planning and education business she launched after over a decade of working as a financial planner. She's helped more than 1,000 clients make smarter financial choices. A proud UQ alum with a Bachelor of Commerce and a Bachelor of Economics, Monique is committed to making financial knowledge accessible to everyone. And today, she's here to share practical tips on budgeting and saving, specially designed for students and grads looking to build strong money habits early. Please welcome Monique, and don't forget to pop your questions in the Q&A function.
Hello, everyone, and welcome. Thanks for joining us today. I'm really excited to be here and to share with you my tips, tricks, and what you can do to improve your financial position. So just quickly, a little bit about myself. So I grew up in a single income household. I didn't earn an allowance, but I did make some pocket money, 20 cents at a time. So from those very humble beginnings, I started work at 15, started saving, started investing. I bought my own home when I was 26, paid off my HECS debt, and now I'm working on becoming debt-free and planning for early retirement. And the reason why I tell you this is not only am I trained in commerce, economics, and finance from UQ, but I have personal experience in the area as well. So just there on the left is me as a 22-year-old financial advisor, first day on the job. Very excited to be there, just as excited as the day I bought BHP. I posted it on my Facebook. So let me jump in. Here's a couple of key takeaways that we will be discussing today. So I want you to leave this session with a set of financial goals, what's important to you, and a plan for how you're going to get there. We're going to look at creating a budget and monitoring your spending so it doesn't get out of control. The first step to wealth is building an emergency fund. So we'll talk about that before steps to grow your wealth and also avoid common financial mistakes. So to set yourself up for financial success, the first step is to identify your goals, not just your financial goals, but your life goals too. You need to have a look at what you value and what's important to you in your life. So I'd love to know in the chat if you already have goals. Have you told anyone about them? Are they written down? Are you keeping yourself accountable? So the first thing to do, let's make them SMART goals. For example, if you want to save for a house deposit, $100,000 in 3 years' time to buy a home. That's a very easy goal to write down, not necessarily to achieve, but why do we want to do that? The why is just as important as the goal itself. So for me, it was important that I could build my assets, I could feel secure in my living situation, saving on rent. But actually, most importantly for me, it was so that I could have a cat. Which I couldn't do in a rental. So I broke that down. I said, let's save $641 per week. That aligned with my pay packet at the time. And there you go. You have a very quick action plan for your goal. So the next step after you've written down your goal is to track your progress. So for yourself, you need to set a calendar reminder, whether it's weekly, whether it's monthly. I recommend everyone at least has a look at it annually for those really big, hairy, audacious goals. But for the small goals, you really do need to look at it on a weekly basis. If you write it down and never look at it again, unfortunately, you won't be making progress. So then once you've hit your goals, what do? You have a big summer blowout and you blow the budget. No, we don't. We stop, we take a breath, and we do celebrate. So you need to pat yourself on the back, give yourself a small reward, but don't undo all that hard work. So, for example, if you received a bonus, $10,000, maybe you commit just 10% of that towards a holiday to reward yourself, but we save the rest. And importantly, life is ever changing. So, one goal that you have today doesn't have to remain static throughout your life. You could pivot, decide you don't want to buy a house anymore and you want to invest instead. So, that's why you need to keep reviewing, keep adjusting your goals as you go. Okay, so the next thing that's the most important is to understand your spending. You wouldn't believe the amount of people that I speak to that don't even know their income. So let's write it down. Have you got a pen and paper in front of you? Let's do it together. Let's start making progress. The first step, identifying your income. Where is it coming from? Is it coming from work, side hustles? Do you do Uber Eats driving on the side? Are you getting interest from your cash in the bank, dividends, rental income, maybe even trust distributions? Let's note every single item down. That's step one. Step two, compulsory expenses. Now, I don't like to say fixed expenses because there is still some wiggle room in there, but it is something you can't avoid. We're looking at tax, and you'll hear from Vanessa later about the best ways that you can minimize tax. But other compulsory things for us, rent or mortgage, utilities, and just food to eat. So let's pop those in one bucket. We can still improve on it, but it's something we can't totally avoid. The next section is discretionary expenses. So I like to give myself a fun money budget. So it doesn't matter what you want to put in that funny money budget. You can spend it on rock climbing, on the gym, you can spend it on holidays, whatever you want, and you can spend it guilt-free because you know that you've budgeted for it. So after that, income minus expenses gives us a surplus or deficit. So in our surplus, what are we doing with it? Are we putting that cash just under the mattress, not even earning interest? Are we putting it in the bank? Are we shopping around for the best deal? Or are we investing and earning even more money for ourselves in the future? Or are we paying off our debt? So just here on the right-hand side is what the Barefoot Investor believes is the best budget. So he thinks you should save about 20% of your after-tax income. So for me, I personally don't think that's enough. And I also don't like to stick to fixed percentages like that because everybody's situation is different. If you're a very high income earner or a very low income earner, these percentages are not going to be very useful for you. So as a rundown, my budget looks a little bit different. I aim to save a really high percentage of my income. And this week I looked back at my salary, my budget, all the way back to when I first graduated and had my first full-time job. And I was surprised to see I've kept roughly the same percentage of savings no matter what my income was. So that's 50%. So there's my challenge to you to see if you can save a little bit more than what you're doing today and save as much as possible. So what else is different in my budget? At the moment, my housing is about 20 to 25, but when I first bought my house, I spent 50% of my budget on my mortgage. So then splurge, 20%, it's a bit high for me. I think mine's closer to 10. Utilities, transport, insurance, I keep those all really low. So all of these bottom categories here, I think total about 12% for me. So you're thinking, oh, I don't like this girl already. It sounds like she never has any fun, but that's not it at all. It's about prioritizing what's important to you. So after you completed the first step of your goals, you might have written down that it was important for you to travel to Italy and spend a month there and eating out and, having a wonderful time. That was important to me too. But it means you've got to trade off other items. So it means I'm not going out weekly in Brisbane, not getting cocktails, not getting late night Ubers home. Those things aren't important. So that's where budgeting is individual to each person. Now, if you thought making a budget was hard, monitoring your spending and keeping yourself in check is even harder. So, luckily, there is a bit of technology on our side these days. It's not just a pen and paper anymore, although that does work really well for some people. And a friend of mine actually started a pen to paper budget, and they had to write down every single thing that they spent. And just because they had to write it down, sometimes they wouldn't actually make the spending. They would decide it was too much bother to write it down, so I just wasn't going to buy that snack. So let's use apps. Let's use a spreadsheet. I've got plenty of spreadsheets of my own, and I'm happy to share those with you online today as well. You can review your bank statements. That's really important when we set our initial budget, to go back to see where you actually have spent in the past before setting your goals for going forward. In your bank, in one of these apps, you can set spending alerts as well. So maybe you want to know every time a bill comes out that's over $100. Just knowing, being reminded of these things can help us improve. And another thing, you don't have to actually keep an eye on your budget like a hawk when you get good at budgeting. What you can do is have your budget limits in mind. So every time you go to the supermarket, have your budget limit front of mind. So you might say, I want to spend $100 this week at the supermarket, and then try and stick to that. You go out for lunch, you buy a coffee, are we spending $4, $5, $10? Whatever you've set as your budget, keep that in mind. Don't blow out the budget. Don't go crazy one week. That's an easy way to keep yourself in check. Now, interestingly, everything in life is a trade-off. You've got many, many choices to make. And when it comes to budgeting, it's kind of three main things that I find people struggle with. You can choose to have something that doesn't take much time or effort, but it'll cost you a lot of money. Something that might be no effort at all, and it's quick. You get what I'm saying. You can't have all three at the same time. So, for example, when I was a student, I was a waitress. I had to get from St. Lucia to South Bank. I had a few different options of how I could get there. The most expensive one was driving and paying for parking. That saved me a lot of time, and it was not a lot of effort. The next step up is I could ride my bicycle to the ferry stop. Then I could take the ferry, pay $3.40 each way, and get myself to South Bank. So that took a little bit more time, a little bit more effort, and it was a little bit cheaper than driving and paying for parking. The third option, which I never did because it would take too much time, too much effort. It was free, but I could have run all the way into work, but that didn't appeal to me. But the point is, every decision you make with your spending is a choice and a trade-off. So you just have to decide what's important to you. Okay, so how can we actually improve our budget? So in our equation, we've got income coming in. How can we improve that? Let's try to increase our income as much as possible. Taking up extra shifts, extra work, getting promotions. Maybe you've got secondary income streams like dog sitting, house sitting. Over time, you'll build your assets, and then your assets will give you income through investing. Then you want to decrease your expenses. So those compulsory expenses I mentioned are still negotiable. So you can reduce your tax if you're smart, if you keep your tax receipts, if you speak to Vanessa. So we can bring those down. Compare all your bills. At least once a year, you need to review all of your big bills, every insurance policy, every utility. You need to make sure you're getting the best deal on the market. Don't be afraid to switch. Many things that you can do there, but for some people, it may already be optimized, so you might have to look further into your discretionary expenses. So this one is tough. But if you really want to save, this is where you can cut. And sometimes you can even cut down to zero. So before you make a spend, ask yourself, do you really need this? Or do I just want it? Look at things like subscriptions. Do you have Spotify, YouTube Premium, Amazon? Do you have the works? Why don't you just keep one source of entertainment or use free options? Maybe you even have Disney Plus 1 month, cancel it and start Netflix the next. You can't possibly watch both at the same time. A great idea from my perspective is to reduce your impact on the environment. So reduce, reuse, recycle, repair, borrow. Whatever you can do to stop yourself from spending. Can you use less of a certain product? Can you use something you've already got at home, but maybe you didn't think about it in that way before? Can you recycle? Is there repairs that you can do at home to a button that's fallen off? Get that jacket back into rotation rather than buying a whole new one. And borrow, that's my favorite. So I've become very good at borrowing over time. So here's an example. So I need to fix my roof. So I need a big ladder. I don't have a ladder. I've thought about the ladder I have, the step ladder, not tall enough, not going to work. What can I do? $330 at Bunnings. It'll take me an hour to get there and back. I'm going to buy the ladder, then I've got to store the ladder. Then I fix this thing in just 5 minutes and it's cost me all this money. Or I can speak to my neighbor, ask if I can borrow their neighbor kindly. Maybe I'll trade them a couple of eggs. And then, that's a much cheaper option and it's also good for the environment. All right, now surplus. So once you've increased your income, decreased your expenses, you've got your surplus. Now we're going to pop some funds in a separate bank account so we can't touch it. So you may not even have a login and you have to try really hard to get in there, but that's going to be your emergency funds. Once that's established, you can start your savings plan. So pay yourself first. Put that as the first transaction that goes out before you do anything else once your pay comes in. After you've got a handle on your emergency fund and your saving, that's when you can start to invest. Now, I hope you're excited for this one because I am. This is a ChatGPT generated meal plan. I asked it to generate me a meal plan for one person for $65 a week. Now, a lot of people say, whoa, that's not a lot of money to work with. But in fact, this budget came in under. It's some really basic recipes. They're not the fanciest, they're definitely not the healthiest, but it is possible. So here's my tips. Look at what you've already got at home before you go to the shop. Can you use something that's been in the back of the pantry for a while to cut down on what you need to buy this week? Make a meal plan before you go out. Compare the prices. Are you looking at the apps or catalogs online? See what's advertised between Woolworths, Coles, and Aldi for the week. Then, once you've done that, create a shopping list. Then, once you're actually at the shops, why don't you stick to it? It's really easy to go into the middle aisle of Aldi and buy something you just don't need. Set your budget for the week for your shopping before you go. Consider other things like rewards, cashback, but don't spend just because you'll get some money back in the future. I see people get an alert, oh, when you spend $100 this week for 4 weeks, we'll give you X amount of points. If you aren't going to spend $100, forget it. That's not important to you anymore because the points are not going to pay back that extra spend. So then when you're at the shop, avoid the middle aisle, stick to the perimeter. So you've probably heard this one before, but if you stick to the perimeter, that's where you get the whole foods, the fresh foods, less processed, which is generally cheaper. So if you have a look on the right-hand side here, who knew you needed a plasma cutter from Aldi? I don't even know what that does, but imagine coming home from the supermarket with a $300 thing that you just didn't need. Then we could buy home brands. Let's have a look at this rice. Woolworths branded rice, only 40 cents per 100 grams. We could buy brand name rice. That's going to cost us a little bit more at 70 cents. Then if we think about something that's semi-pre-cooked already, that skyrockets our price to $1.46. So where you can buy low processed foods and home brand. I'm not a rice expert, but to me, they taste the same. On every item you buy, compare those unit prices as well. Buy in bulk where it makes sense. On this rice, it doesn't make sense. But on occasion, this basmati rice goes on sale 50%. At that point in time, you might consider it. Where you can't buy exactly what you want, like these blueberries, $7.50 a punnet, that's above my threshold. I won't buy blueberries above $4. So I might switch to freezer berries, which are much cheaper on unit price. When they come back in season though, their price will come down and then suddenly fresh blueberries comes back into my shopping basket. If you just squeeze a look on the right hand side, peaches last week, $30 a kilo. Now that is something I just can't justify. I love peaches, but at this price, not coming home with me. So what do? I consider if I would still want peaches, maybe I'm going to buy canned options for only $3. So the last few notes for you on this one is if you're really running a tight budget, take a calculator with you, add up your spending as you go, or preload it into Woolworths or Aldi online, get the total, and then stick to your shopping list. Now, what do you do once you get home? Check your receipt. There's a few reasons why I do this. So I want to know for everything that I've bought, is there any mistakes on there? Anything been double swiped? But how much have I actually paid? I bought 5 bananas. How much is it per banana? Then that helps me when I get to one of these later points about leftovers and letting food go to waste. I'm going to say, just like this little guy rummaging through the bin, this banana's gone off. It's gone brown, don't want to eat it anymore. I've just wasted $1. So picture throwing that dollar into the bin. You could be very thrifty and turn it into banana bread. So check your receipt. Strategize what you eat first. Salads are going to go off quicker. Leave frozen items, dried items till last. Storage, leftovers, and batch cooking. So those are my other tips to reduce what you're throwing away. Okay, so for some people, you might be really hard pressed at the moment. You might be feeling the cost of living. You might have to adopt a bare bones budget. So it means we're going to, unfortunately, cut out most of our discretionary expenses. A couple of other tips for you is to ask for help where you can. So I don't want you to be afraid or too proud. There's lots of options that can help you. Centrelink, family, you can even call your bank, or a couple of other items that I like is doing everything that's free. So why sign up to the gym when you can go running on the road for free? There's community pantries, street libraries, the actual Brisbane City Council library is free as well. There's a lot of good options out there. You just have to find them. So we've sorted our budget. We've got a surplus. What are we going to do with it? I already mentioned an emergency fund. So here's a quick survey that I did on LinkedIn a few weeks back. 73% of people said they had savings for an emergency. Great. I thought everyone is sorted, except for these few people that said they would rely on a credit card because they didn't have savings. Some other people will reach out to family or friend, or one person was 100% invested and they said they'd have to sell some assets even if the market was down. So don't put yourself in that position. Have an emergency fund ready to go. So the net wealth equation. We've got assets less liabilities equals to your net wealth. Once you've saved some money, that surplus is going to flow into your assets. What we can do is increase our assets as much as we can through interest-bearing accounts, shares, real estate, business ventures, and we can also minimize our debt, pay off high interest debts first, get down to zero, and only take on debt where it makes sense, such as for an investment property. Vanessa will also tell you that's tax deductible. Okay, so passive income. So if you're not like this cat who's got two passive incomes at home, who feed him every day, you might have to look for investment opportunities. So there is, of course, risk with investments, and that's another webinar all on its own. But here's a few ways. Investments, rental properties, shares. And these days, you can actually make a bit of money through YouTube, digital products. If we think about Kayla Itzines, she started with a downloadable PDF for workout plans. She would charge a really small amount, $10 per download, and slowly she built up into a multi-million-dollar app. So lucky with technology, we can do these things. Saving money on your mortgage. So you've probably heard this before, an offset account does save you money if you use it properly, but it is also a pot of money that makes you feel a little bit richer than you are, and you might be tempted to draw down on it as much as you want to leave it there. So use it well, learn a little bit about it. Also think about asking your bank for a better rate. The Bank of Australia has dropped the rates a few times recently, but your bank may not have done the same. Every year, it's worth comparing. Put that in your calendar. Make sure you call the bank, call your mortgage broker, ask for a better rate. You can also make additional repayments. The rates that the bank asks you to repay, make sure that you're debt free at 30 years. That's great for the bank, not so great for you. So if you want to make extra repayments, that goes off the principal. It also reduces your interest over time. Redraw as well. So that could work just as well as an offset account, but sometimes has lower fees. So consider that. Financial mistakes. So I've seen the budgets of thousands of people by now, and there's a few things that I've identified. So don't let yourself fall into these traps, but not budgeting properly is the first mistake. That's why I wanted to talk about that today. Debt management is important as well. Most people don't realize that if you get afterpay debt, credit cards, it can ruin your credit score, which might impact buying a house in the future. But it also is just costing you unnecessarily interest. Would you buy a pair of shoes for $200? Maybe you would. Maybe you put it on Afterpay, but would you buy that same pair of shoes for $250? Because that's what it's going to cost you once you factor in the interest on that purchase. Using credit cards as kind of a lifeline. You start to save, you overspend, you put it on your credit card, you use your savings to pay off the credit card and you go all over again. That can be hard to escape. And also sitting on your hands a little bit, living for the now and not saving for retirement. A couple of ways you can you can avoid these mistakes. Put your goals front of mind. So I'd love to see everyone put their hands up if you have goals, if you've told someone about them, and if you've got an accountability partner. I'm looking for those hands. Has anyone got their hand up? Okay, well, if you don't have an accountability partner, tell someone about it and make sure they ask you how it's going. Put systems in place. So that's what I was talking about, paying yourself first. Have those automatic transactions go out before you do anything else. Don't rely on yourself to say, oh, I will save at the end of the week, I'll put whatever's left across. Do it first. And avoiding temptations. So save yourself from yourself. I've suggested to my sister she needs to unsubscribe from every email so she never knows what's on sale. That is a way you can help yourself. Close your Afterpay, close your credit card, delete any apps. If you're serious about savings, help yourself in that way. And then the last tip is to practice delayed gratification. So you might have heard of the marshmallow experiment for children, where they can either have one marshmallow now or two marshmallows in 5 minutes. I challenge you to test yourself. If you don't buy something today, you can buy something bigger tomorrow. Now, thank you for listening. If you want to keep the ball rolling, you've got a budget, you've got a spending plan, you've got some goals, don't be afraid. Subscribe to my newsletter. You'll hear about upcoming webinars, or book a telewealth appointment. So that's all from me. Over to you, Nandu.
Thank you so much, Monique. That was very insightful, and I'm sure the the viewers found it very interesting. There are a few questions for you. And so I think the first question we can start with is, what's a realistic emergency fund amount for a single person?
So that depends on your spending. So it is advisable to have about 3 to 6 months of your spending in an emergency fund, but that number is going to be different for everyone. When I was a student, I thought 10,000 was the bee's knees, and any amount above that I invested, but it's personal to you.
Of course, 100%. And second question we have is, what financial red flags should young couples be aware of when entering a serious relationship or sharing finances?
That's really important. Yeah. And it is a big transition from being single and looking after yourself to combining your wealth with someone else. So, the first thing I'd say is you need to talk about it. You need to set a financial date night, put it in the calendar. Every month, you need to check in. You need to be on the same page with your goals. What if you're a spender and they're a saver? Maybe they're not the right person for you after all, if you're going to be continually butting your head up against each other, fighting about these things. But in terms of red flags, I think you need to put it all on the table, have an honest conversation about what you're bringing to the relationship, who's bringing afterpay debt, who has the assets, who has the debt, who's bringing income, who's bringing expenses. And once you have all the information, you can make the decisions together about what you want to do going forward.
100%. That makes a lot of sense. And this is a question I also have. How do you balance savings and investing?
It's a challenge, and like the time, money, effort trade off, everything is a balancing act. So I would say once you've got your emergency fund set up and you're really confident with that balance, you can feel free to invest the rest if that aligns with your goals. So if your goals are to invest, to grow your wealth, maybe it's to buy a home, all of those things you can do with investing your money. If you've got short term goals, maybe it's Euro summer, then that money really should stay in cash. So you've got your emergency fund, you've got your holiday fund, and then anything long term that can go towards investments.
Yeah, that makes a lot of sense. 100%. And I think we can come to a final question, which is it true that in order to buy a house in the future, we need to get a credit card and have a credit history to be trusted?
So I think that's a bit of a misnomer that the banks are spreading, because they want you to take out credit cards and they want you to use it irresponsibly and pay 24% interest. But you don't need a credit card at all. So if you've got great income, great savings, the bank is going to look on that more favorably than even just one missed payment on a credit card.
Yeah, that makes sense. Thank you for that. I think that should be all the questions for now. Thank you so much, Monique. And we will be moving on to our next speaker for the night. And our next speaker is a tax expert who knows exactly how to help you get most out of your tax return. Vanessa Gray is the founder of Vanessa Gray Accounting and Tax, and she's a UQ alum with a Bachelor of Business Management and a Bachelor of Commerce. She has 19 years of experience as a chartered accountant, and since starting her own firm in 2016, she's built a thriving practice, supporting sole traders and service-based businesses with a practical, down-to-earth tax advice. Today, she'll be sharing her top tips and tricks to help you maximize your tax return. Please welcome Vanessa, and don't forget to pop your questions in the Q&A function.
Hello, everyone. Thanks for that introduction, Nandu. Uh, and thanks to all those who are staying on the line for the exciting tax segment. Sometimes it's not the most exciting thing. So I'm very happy that you've stuck around. Firstly, I just thought we'd quickly go through what I'll talk about today. Just quickly, who I am, some practical tips, then some deductions, because everyone loves to talk about deductions, and then finally some miscellaneous helpful tips as well. So, as Nandu says, I have about 19 years experience. I started my practice in 2016 and have built it up over the last 9 years. I've previously worked for mid-tier accounting firms, doing a lot of compliance and business management outsourcing items. Before I started my business, I moved into a global organization where I was a tax manager for Australia and New Zealand. And today I have 2 part-time employees that I work with, and I do work with mostly professionals, a lot of doctors and other professionals. I'd like to start with some practical tips because I think we can get bogged down into what you can claim on a tax return. It's important to kind of get the fundamentals right. So basically, to start off with, I hope you've all able to access your MyGov, your ATO app on the MyGov app. And this is where you'll find all your relevant tax information, what you owe the ATO, what your refunds are, where your notice of assessments are. You can access this via the internet or via the app. But most importantly, but most importantly, you really need to keep your tax file numbers secure. Don't give your tax file numbers to anyone. Don't send it over email. I've had a client recently who had their tax file number compromised, and it can cause a lot of pain points. She now has to ring up the ATO every time she needs to use her tax file number. So it's really important to keep it secure, and don't send it via email. If you have to send it via email, put a password on it somewhere. Not completely tax related, but it's also important to know where your super's at. So know that you can access your super account. So most super places have apps these days. So you just have a super app on your phone. And the reason for this is it's important to know that your employer is paying your super. It's good to check that what's coming onto your pay slips is being paid into your super accounts. Unfortunately, there are a lot of circumstances where employees have not been receiving their super payments, and a lot of people don't notice because they don't check it very often. At the very least, check it once a year when your super fund sends you the yearly statement. The other way to look at it is you can actually look at super through your MyGov app. So if you don't have the app for your super fund, definitely at least have a look at the MyGov app and check that your super is being paid there. As an aside, there is something coming in the future years where it's called payday super, where employers will be obliged to pay everyone's super when you get paid at the same time. This is probably my biggest tip. Just keep records. Keep records of everything. I think even Monique alluded to it previously. So the big ones are obviously keeping invoices, keeping receipts. If you use your car for work, keep a logbook. We'll go into the details a bit later. If you're traveling, keep diaries. If you're working from home, keep a diary of your work hours. there's lots of different ways that the ATO wants you to keep records, and that's some of them. You can use bank statements and credit card statements, but these source documents are often better. Also, how do you keep track of these things? So the best way to keep track is, if it's a receipt, take a photo of it, keep it somewhere where you know you can access it. Use apps. For example, if you're using a logbook app, you can use a logbook app. There's plenty of them around. Also, the ATO have a really good app in keeping track of deductions. So it allows you to keep a photo or a record of the expense, and at the end of the financial year, you can download it into an Excel spreadsheet and it has a summary there for you. So that can be really helpful as well. If you're taking photos or scanning documents in, make sure that you keep it in a place where you'll be able to find it down the track. So if you've got a laptop, put it on your laptop in a file, mark it, tax return 2025. Easy. Question that's often asked is how long do we need to keep everything? The ATO prescribed 5 years. Technically, with the statute of limitations, it's 7 years, so we just say 7. Interestingly enough, the ATO can only amend individual tax returns going back 2 years from the notice of assessment, unless they suspect fraud or evasion. So if they think you're doing something really bad, they can go back as far as they want. But yeah, if it's just a simple mistake, or they think there's a simple mistake, they can only go back 2 years. So this is the one thing that everyone loves to talk about is deductions. This is my favorite scene in Schitt's Creek. Basically, we'll just go through some deductions. I'll go through the main ones. So motor vehicle deductions, travel expenses, some laundry and PPE deductions, self-education, other work deductions, and then non-related work deductions such as donations, and there's other deductions you can claim as well. So just going through what you can claim for car expenses, not everyone will be able to claim a car deduction. But if you do have a job where you use your car for work, there are 2 ways you can claim expenses. There's either the cents per kilometre method, or there's the logbook method. If the cents per kilometre method requires you to keep track of all the kilometres done in your return and claim it in your return. You can only claim up to 5,000 kilometres with this method. It's fairly straightforward, but you do need to keep track of every single kilometre you drive. But it is probably useful for people that don't do a lot of driving for work. So it can be handy to use that method. For the 2025 financial year, it's 88 cents per kilometre. They've been gradually increasing it over the last few years. The logbook method is a bit more involved, but it would be useful for someone like a salesperson who's traveling a lot for work and perhaps has a car allowance. Having a logbook allows you to claim a percentage of all your expenses on your motor vehicle, such as services, fuel, depreciation, interest on the loan of the vehicle, insurance, and so on. If you do a logbook, you're working out the private versus the business use percentage. Also, home to work is generally not a deductible business trip unless you can manage an exemption. I won't go into the exemptions tonight because they can be a bit complex, but there is some exemptions there. Simple basics though, if you are reimbursed, then it's not deductible. If you have a novated lease, you can't claim it either. So I know in some circumstances, employers will reimburse employees for cents per kilometre. Generally, this would not be deductible as long as they're also not reporting it to the ATO. Other deductions include travel expenses. So you can say, for example, you were sent away to a seminar for work and your employer didn't reimburse you for their expenses, for all of your expenses. Say they paid for the flights and they might have paid for accommodation, but perhaps they didn't pay for all your food, or maybe some taxis or something. That's when you're allowed to claim some travel expenses for this. But there has to be a connection between this and your employment. So in circumstances where you may go on a trip and maybe you were there for a seminar for 2 days, but you might have stayed for like 4 or 5 days, you can only claim a portion of that because that portion is related to your work. Moving on to laundry and PPE. Laundry is one of those things that everyone wants to claim because it's easy and it's a simple deduction. Generally, they have to be either compulsory or protective things like high-vis vests, scrubs for doctors and nurses, a uniform, or an embroidered shirt with like the logo on it. They would be relevant for laundry. Simple dollar per load or 50 cents per load if it's mixed in. These items are so kind of small and don't and haven't changed since the whole time I've been a tax agent. But in addition to this, you can claim expenses that are related to PPE, so protective equipment, protective uniforms, protective shoes, that kind of thing. So examples would be steel cap boots if you had to go out on a building site, safety glasses. In some circumstances, you can claim sunglasses and some sunscreen as well if your job involves being out in the sun a lot. Next, we have the self-education expenses. So the general rule is you should have been employed prior to commencing the education, and there needs to be a connection between the education and your employment. An example would be that's not relevant would be studying psychology while working as a retail assistant. That's not deductible because that doesn't have what we call a reasonable nexus between the two items. However, a receptionist who takes on an administration course would have a significant nexus with her work. It's not just the course you can claim. You can claim textbooks, you can claim travel, travel away if you need to. You can't claim HECS help, but in some circumstances you can claim course fees paid through Fee Help and VSL. So moving on to other work deductions, basically anything else that doesn't fit into the previous deductions would be classified as an other work deduction. Things like professional subscriptions, for example, I'm a chartered accountant, I have to pay fees to chartered CAA and Z every year. That becomes a tax deduction. Other things that may be of use, some people have to pay union fees, so that becomes a deduction. Reference materials and apps that you use for work, stationery, phone expenses, work from home expenses. So just diving into work from home expenses a little bit, as I know most people do a little bit of working from home pretty much now every day these days. I'll mention here that they've changed it now to 70 cents per hour that you can claim. So there's two methods. There's the 70 cents per hour method, or there's the actual method. The 70 cents per hour method is quite restricted in the fact that you need to have a diary for it. So you need to be keeping track of every single hour that you work for your job. So that means people that have to log timesheets, or if you've kept a detailed diary of the hours that you've worked, that can be quite handy and will help you describe that diary that is required for the ATO. But if you haven't kept track of it, then it really means that you can't use that method. The actual method, actually, I'm finding is becoming a better option in any case, just because I've noticed that some people's phone bills and internet bills and that kind of thing are just not getting covered enough by the cents per hour method. But it is a lot more work. So it is a better option. We won't go into all the specifics of it, but basically you do need to keep all the receipts for electricity. You need to keep track of your phone and your phone use, and internet use. So it can be quite full on. Also, you can only use it if you have a designated space in your house, like a study. So that's important also to claim that. So we finished with work deductions, and now we're looking at other deductions. So things that you don't actually have to have a job for, if you've got passive income, I suppose. So donations are one of them. You're probably very familiar with donations as a nice tax deduction. But there is a bit of a misconception with donations. In the first one is it has to be a designated gift recipient. So this is a special kind of badge, I suppose, if you'd call it, that is given to a charity that says, yes, people who make a deduction to your charity can claim a tax deduction. Now, this isn't given to every charity. It's not given to every charity. So you have to be really specific in what you put on your tax return. The charity, there is a lot of donations that people think they can claim for GoFundMe. The misconception that if I help my sick friend's cat through my GoFundMe, I'll be able to claim a deduction, unfortunately, is not the case. That seems to be a very common misconception that I'm seeing. And also, it might be a charity that you genuinely think would be a DGR, and it's not. So you can actually check this by going onto the ABR website, do an ABR lookup or ABN lookup on the ABR website, and that will tell you if it is a DGR. I had a client that made a large donation to a church, and genuinely, I even thought it was tax deductible. And when I looked it up, I realized that the church didn't have DGR status, and so we couldn't claim it as a deduction. also with deductions, you can't receive anything in return. So it can't be a raffle, or it can't be a, you buy a badge or something. It's just pure money given to something. Other deductions that don't need to be related to your work are things like income protection insurance. Some people have income protection some people have income protection insurance that's not in their super funds, and this can be a tax deduction. Also, tax agent fees are deductible. In some cases, financial advisor fees are deductible. Any expenses relating to investment, and you can also make extra super contributions. I've got their concession. I won't go into all the details on this, but if you make an extra super contribution and claim it as a deduction on your return, that can also be an extra deduction. So looking at other miscellaneous tips, I guess, I just thought I'd share that the tax rates for 2026, they haven't changed. The government announced in the budget that they were changing the 16% threshold. So that's the second tier, just the one above the non-tax-free, the tax-free threshold. So they're dropping it to 14%. As of next financial year, so in 4 days time, the super guarantee rates are changing to 12%, and that is where they'll stay. So they're not changing now for a very long time, the expectation is, but it will stop there. Also, I mentioned before a super contribution. If you make a super contribution, you can claim a tax deduction. So that cap that relates to those contributions, which also include employer contributions, you can make a contribution up to $30,000 in any single year. And that's not going to change either. I wanted to also remind you that your tax return's not all about getting money back or getting a refund or anything. It's important to note that we have to include all sources of income. So this could include passive income that Monique talked about earlier, such as interest, dividends. Maybe you've got crypto that you've sold, shares, or an investment property you might have sold, business income. So that's all other income that might need to be included in your tax return. You'll be surprised at how much the ATO do know about you and everyone else. So a lot of your income doesn't fall under the radar. The ATO will have some kind of knowledge of what income you've received. So I just also wanted to kind of give you some background on the Medicare levy and the Medicare levy surcharge. To simplify it, most people will pay the Medicare levy. So that's 2% on top of those tax rates that we saw previously. But there's also the Medicare levy surcharge. And this is for people that are over, so I have there that for a single person that's over $101,000 in a year for the next financial year, and you don't have private health cover, hospital private health cover, then you will end up having to pay the Medicare levy surcharge. Coming to the end, this is my last set of tips. But I thought you might be wondering when it's important to see an accountant. So I trust that most of you can probably lodge your own tax returns if it's fairly straightforward, if it's salary and wages. But I thought you might wonder when it might be a good idea to see a tax agent. So things like if you started renting a property, so you've bought an investment property and you're renting it out, or you have your own home and you've decided, oh, I don't want to live here anymore, I want to rent it out. That's when it's good to get some advice from an accountant as to what the implications are for tax purposes. Capital gains, so you might have sold some shares or you might have sold a property. That's really important to get right. Property especially can be quite tricky. There's a lot of different rules for rental properties. So it's important to kind of get a handle on that information. Cryptocurrency can be quite tricky. The ATO have come out and said that they don't want to change the rules on cryptocurrency, but they've kind of lumped it all under capital gains and not really put a lot of thought into it. And I think we're finding that cryptocurrency can be kind of a bit different to just a regular asset. So it can be quite complex with all the different things that you can get out of cryptocurrency. So that might be when it might be time to see a professional. So if you are, another reason is if you have a tax debt. So if this could be before or after you've lodged a tax return. But it would be better if you could see an accountant before you knew that you were going to have a tax debt. So a good example, going back to the property, is you've sold a property and you sold a property and you excuse me and you know that you're going to have a tax debt. So it's an investment property, you know you've made a capital gain and you're going to have a tax debt. Well, tax agents can get they get extensions for lodgement. So normally if you're lodging your tax return yourself, it's due on the 31st of October. However, the tax return under a tax agent for most of the time can be the 15th of May. So it does give you a lot longer to lodge. And when you lodge in May, you also don't often have the tax payable until about early June. Other reasons is if you're starting a business and you don't know what structure to set it up under, or you just need help navigating setting up it as an ABN, as a sole trader, or navigating GST, that kind of thing. That's when it's helpful as well. And my favorite one is someone's come up with this amazing scheme that they are making, so they're saving so much tax under, and they're just telling you it's the best thing ever. That might be a time to have a chat to someone. Often with those circumstances, it's not a one-size-fits-all approach to a lot of things. So something that might work for someone may not work for you. So that's when it's helpful to have that conversation with a professional to say, hey, this works for my friend. Is that going to work for me? And that's when it's best to kind of nut it out and see if it's really a valid idea. I just also have left a few helpful websites there on the bottom. Always go to the ATO website first. to find out the information. That's going to be a source of truth. A few years ago during COVID, I had clients coming to me with random things on random websites, saying, "Oh, this can happen. We can do this, and we can do this." But it was a lot of trying to kind of work out where the source of the information was coming from, and a lot of the time I just redirected my client to the ATO. Other things that are useful are the TPB public register, which has all the tax agents and who's registered. So you can check if your tax agent is registered. And the final one is the MoneySmart website. That's also helpful. That has a lot of tools and calculators as well. Yeah, so that's pretty much the end. Did you have any questions?
Perfect. Thank you so much, Vanessa. And yes, we do have some questions for you. I can start. So, when you are claiming an expense such as scrubs, how
Yep.
much of that expense do you actually get back?
So the amount of the expense is determined by your marginal tax rate. So it's not of if I claim a deduction of $100, I get $100 back from my tax. It's basically whatever your highest marginal rate is. So say you were earning at the highest marginal rate of 47%, that would be the amount of tax that you would get back. That would be the deduction you would get. So I think there's a lot of conversations out there where people think that they will receive back exactly what they paid for it, and that's just not the case. It's only going to be ever the percentage of tax that you would have otherwise paid.
100%. That was something I always confused as well. And second question. So, when does a small amount of money gained from a hobby become income for tax purposes?
Yes, it's not actually it's not determined on the actual amount of money. It's determined on a lot of uh, the nature of what you're doing. So if you're just I don't know if you're doing a painting and you just love doing it and you're just doing it for yourself, but then someone comes along and says, "Oh, that is a great painting. I'll buy it off you." And then you never expected any money from it in the first place, then that would be considered a hobby. But when you're repeatedly doing something, you're out to try and make money from something, maybe you're going out to markets or you're showing people, you're putting up things online, putting on things on a website, that starts to look like that you're actually setting up for a business. So the way the ATO look at it is if you're trying to make a profit from it, that's when it starts to turn into a business.
True. That makes a lot of sense. Yeah.
Yeah.
Next question. Can you claim any deductions for expenses associated with the voluntary positions, such as a voluntary board?
No, not really. The reason being is that the first rule of a deduction is that you have to have income associated with it. So if there's no income, there's no deduction. The ATO always will talk about there being a nexus between the income and the deduction. So unfortunately, in those situations, no, there would not be a deduction.
That makes sense. And we have quite a few questions, but we'll get through them. The next question. If a company is paying an employee for tax or for travel between work sites in the same day as via the cents per kilometer method, is
Mhm.
this considered taxable income or an allowance? And does this still need to be claimed as a deduction in the tax return?
Yeah, so it actually depends. So If they're reimbursing the employee and it's the prescribed amount that the ATO prescribe, generally it shouldn't be, it doesn't need to go anywhere. So it's just a reimbursement of expenses. The employer is expecting that expense to be utilized by the employee. So that would generally not be deductible, accessible income. The problem can arise where sometimes employers do put that on their income statements that they submit to the ATO as an allowance. In which case it would just be a matter of also putting a deduction against it for the same amount, because it legitimately, assuming it's the same as the ATO prescribed method. The only exception would be if they're paying, say, $1 a kilometre, they would actually have to put that on as income, and then you would claim the cents per kilometre amount as a deduction.
Yeah, wow. Okay, that makes a lot of sense. And next question. Is there a cap on how much I can deduct for work-related expenses each year? And do these deductions only reduce my tax if I actually owe tax?
Can you just repeat the last bit of that?
Yeah, no. So, is there a cap on how much I can deduct for work-related expenses a year? And do these deductions only reduce my tax if I actually owe tax?
Oh, okay. No, not necessarily. So, now I've forgotten the first bit of it. Is there a cap? No, there
Is there
isn't
a
a
cap?
cap. There isn't a cap, but there's not a cap, but it would depend on whether or not the ATO would see it as a reasonable deduction. So, first rule of deductions, you need to have proof. So you would need to have all the evidence. It has to be related to your income, and it has to not be reimbursed by your employer. So they're your three things for a rational deduction. The next thing is there is no cap. So if you've legitimately spent a lot of things that are legitimate work deductions, then you can legitimately claim them as deductions. And the second part of the question, does it reduce your tax only if you owe tax? It will reduce it down to the lowest marginal rate, so the tax-free threshold, essentially. So the general rule is if you're an employee, you're paying tax every time you get paid. So your employer has to pay tax to the ATO on your behalf. So you would have like a little pool there of money that has been paid on your behalf. If you're claiming a deduction for that, then obviously that's reducing the amount of tax that you should have paid, and it will potentially result in a refund if you've overpaid tax. But if you haven't paid any tax during the year and you're claiming a lot of deductions, you may not get anything back. So it's kind of just a nice balance at the end of the year.
Thank you for that, Vanessa. Next question. If I get gifts from family, such as money regularly from my parents or grandparents, do I need to declare this to the ATO?
Generally not, no. So if it's a genuine gift from your parents or your grandparents, and it's not like a trust distribution, it's not kind of classified as income in any other way, you are genuinely allowed to receive money from other people without having to claim it as a tax deduction. Sorry, as an assessable income. Let's get that right. No, generally speaking, it should not be assessable income.
Yeah, definitely. I've heard that about gifts. Makes sense.
Yeah.
And the next question. So I'm working as I'm a student working for
Yep.
UQ as a casual.
Mhm.
However, each payment has 30% tax. Is it possible for me to claim those amounts back, or should I simply go through the ATO or give them a call?
I assume they're saying that the amount of tax is not correct, or they think that their tax is not correct.
Possibly. Yeah. I'm getting
Basically, so it's up to you. I would speak to your employer to firstly, and try and understand what's going on and why you're getting taxed so much, because it might have been how you filled out your tax file declaration. Or there might be a miscommunication. The other thing is, even if you didn't speak to your employer, at the end of the financial year, it all gets washed out. So, the other reason I would probably recommend doing something about it before you do prepare your tax return is it might be a cash flow thing. So, work it out with your employer, check with them. Maybe you can talk about it and work it out. If in any case, every time you lodge your tax return, it gets all reconciled then. So even if you're paying too much tax now, when you lodge your tax return, the expectation would be that you would get a refund for it.
100%. I think I've personally had a situation like this in the past as well, so I understand. Yeah,
It can be tricky.
of course, 100%.
Yeah.
Next question. It's I own property, so a house overseas, and I'm getting
Mhm.
rent to my overseas account, so not Australian dollars. Should I declare this income?
If you were an Australian resident for tax purposes, so you're not on a visa, um, you are like a citizen or a permanent resident of Australia, then you need to declare all sources of income. So if you are getting income from a rental property that's overseas, it still needs to go on your tax return.
Makes sense. All right, next question. So deductions from past years that I didn't declare, can they be loaded onto later years?
Mhm.
That is the question.
Great question. I get asked this a lot, but unfortunately, no. It's you could do an amendment. So if you're within that we talked about previously, that 2-year amendment period, if it's been less than 2 years since your notice of assessment for that financial year was issued, you could lodge an amendment, but you can't tack it on to another financial year. So something that you didn't claim in the past can't be added to another tax return. If the ATO were to ever audit the tax return and you were trying to claim something from 2 years ago, they would not allow it. So yeah, you can't do that.
Yeah, that makes a lot of sense. Thank you,
Mm.
Vanessa. And I think we are actually approaching time. So I'd like to thank you again, Vanessa, for giving us all this knowledge about taxes that, I wish I knew when I was starting off my career, and I'm sure all the alumni would really appreciate that as well. And I'd also like to say a big thank you to both our speakers, Monique and Vanessa, for taking the time out of, your afternoons to share your knowledge with the UQ alumni community. And I'm sure all of us can actually start applying tips that both of you shared immediately to start taking control of our finances and make better financial choices. Thank you so much again. And lastly, before wrapping up, I would love to talk about all the amazing events that we at the UQ Alumni community have. So we've got some very exciting events coming up. And first up, you should join us for the Young Alumni Friday drinks on the 18th of July. So it's a brand new way to unwind and connect. And it's a more casual setting, so you can just meet your cohort and meet some fellow grads in a relaxed setting. And on the 30th of July, we have our free webinar for how to become a great manager. And it's perfect for new aspiring leaders looking to build confidence, manage people, and handle those difficult workplace situations. And finally, you should definitely save the date for the biggest event of the year, Party with a Purpose. Party with a Purpose returns on the 30th of August this year, and it's our annual sellout celebration. trust us, you won't want to miss it. And this is something I've tried to get tickets for 2 years in a row. I never got tickets, but hopefully this year I will. So the registration links for these events are in the chat now, and this will be included in the post-event email as well. Again, thank you everyone for joining us. Thank you to our speakers. Everyone, hopefully you have a great night.